Let's talk more with Howard Wang, head of Greater China team at the JPMorgan Asset Management side, which helps oversee about $8 billion, at least in total, I think, China assets. Good to have you on the program once again, Howard. I think it's been a while since you stopped by. So what's going on in the markets today? I mean, why are we seeing gains across the board of over close to 1.5%?
Yeah, I think the primary thing is that last week, I think we had a little bit of a scare, right? Tuesday and Wednesday, markets fell pretty precipitously. Shorts were put on. People took a little bit of risk off. So I think all we're seeing is a little bit of a relief bounce from that because, March has been a little bit of a tougher month and January and February, which, notched really good gains.
Relatively speaking, because it's been a pretty good run for the year. We're up 25% for the S&P. Asia markets up double digits as well. So how do you make money from here on?
I think we're still taking a positive view on the markets because I think if you look at the peak to trough drop last year, if you look at the August-September time frame, Asian markets probably fell 20 to 30%. We've clawed back part of that, and we think we can get all of that back because the big looming questions at that point in time, whether China was going to hard land, whether European sovereign debt markets were going to melt down, I think those questions have largely been answered.
Have they? China, the hard landing scenario is still out there, especially being, I think, there's more conviction with the latest economic data points. We got a huge trade deficit, the largest since, 22 years, and then you have 7.5% growth, which was kind of telestrated already by the central government. Still, there was some negative reaction to that, and, slowing fronts on retail, on industrial production, electricity use, you name it. Some people are pretty worried about China right now.
Yeah, I think the important thing is to remember that slowing does not mean stopping, right? And ultimately, all of this was designed basically with two goals in mind. One was to cool off CPI inflation, give the economy a little bit more breathing room. And the second thing, of course, was to correct property prices, give the economy a little bit more breathing room, take away the probability of a hard landing in real estate as a result of forming a bubble and then popping it, and finally just improve affordability, narrow that consumption gap between rich and poor. So I think this is all part of a plan.
All managed, right, by the central government?
All managed by the central government, policy-induced, not externally enforced upon the markets.
All right. Okay, gotcha. So you're up what? Your GF Greater China Fund is up 15% on the year, which is pretty much in line with expectations or the market, basically the market performance so far. So you're not outperforming. How do you get alpha, where you outperform the markets in a year like this, 2012, for everything's going up?
Yeah, I think when you try to focus on things that the market, I think, is still where I think one can be a little bit of a contrarian. So thus far, I think what we've had to do is we've had to basically reverse out of a little bit of the position that we were in at the end of last year, take off some defensives, take down your consumer staples, buy a little bit more of industrials, Chinese property, these type of categories. I think from here on out, what you want to do is you want to, so you can still be a little bit contrarian on direction. I think a lot of people are thinking that this consolidation period will last for a while, gives you a chance to refresh the portfolios, look at themes and valuation gaps. And then second, I think look for better companies that will report earnings above expectations, property companies where the net asset values are a little bit understated, these type of situations.
And speaking of property, this morning we've been talking about a lot about China Yuan or Van and it's reporting a profit up 32%. That's despite the fact you have property curves, clamp down on mortgages, but this company continues to sell these small and medium-sized homes, which I thought was for speculators, mind you.
Well, I think that these kind of property companies would claim that these sales are actually going to end users. And ultimately, I think what it's illustrating is that in all of China, you could have property volumes decline, you could property prices decline, but people who want to buy property still want to buy one from a leading developer. Because I think when you look at the number of the high-quality listcos, they're reporting great earnings growth, they're reporting contract sales growth. Things are actually going well in a certain segment of the market, and that means that certain people are getting a lot of market share at the expense of others.
They're up 30% since the depths of October, these big property names. Is there more to gain? I mean, why don't you just take some profit now and close up some of those positions?
Well, if you take like the Vanke, if you look at the B share, which is accessible to everybody, it's probably trading at something like about a 45% discount to net asset value, assuming prices and volumes contract quite a bit this year. So valuation-wise, there's still good room to go.
So Howard, are you prepared for any tightening coming down the pipeline? I mean, we're all expecting it, waiting for it, so we just don't know when it's going to come. Yeah,
you know what I'm prepared for? I'm actually prepared for data to look kind of bad. Like just the things that you mentioned before. More broad evidence.
What's worse? I mean, we're already missing the targets. Isn't that pretty bad already?
No, because I think if you look at the last couple of years of the Chinese markets, the economy's actually done very well. Growth numbers looked very solid. There was acceleration in certain sectors. What was really bad was the stock market because people are afraid of tightening. Ironically, I think we're in a reverse situation where the slower things get, I think the better markets feel, and I think today's move is an evidence of that.
Right, because you got to bounce back up at some point, don't you?
Yeah, because basically what you had was you had low inflation numbers, lousy growth numbers, and you think that the government is probably going to take the clamps off of certain parts of the economy as a result.
Picking bottom is really difficult, I have to say, Howard.
Yes.
And finding alpha is very difficult because right now it's a beta market, isn't it? Everything's going up, everything's in line, and but coming from here on, I mean, beating expectations is really difficult, I would have to say.
Yeah, although I think we're starting to see certain segments where we could see expectations being beaten. Chinese banks, one prominent segment. People, I think, were forecasting hard landing, a lot of credit costs coming up, and I think people are reversing out of that type of stance this year. There are going to be pockets in Greater China, in Asia, where we're going to start to see earnings expectations changing. So I think we'll move into a little more of a rational environment from the last 6 months, which has been beta going down and then beta coming back up.
Right. Are you saying it's been an irrational environment?
I wouldn't say it's irrational.
Is there something rational in the markets? I mean, it's pretty hard to pick.
I would say it's just a quote-unquote correlated environment where certain big risks dominate the entire global stock market.
Okay, so let's talk about tightening because people want to talk about triple R, people want to talk about interest rate cut. First of all, do you think there's one down the pipeline somewhere? Are we going to get one at some point? Yeah,
well, I think it's pretty evident that the triple R is, one, a very unusual tool from a global bank standpoint, and then second, that liquidity is quite tight in China. So it's likely we're going to see a series of triple R cuts coming down the pipeline. Interest rate cuts, probably less so. China doesn't really regulate the price of money as much as it regulates the supply of money.
Okay, gotcha. Now, taking a look at some of your big holdings, you like technology. I mean, I'm taking a look at Taiwan Semiconductor, chip maker, China Mobile, et cetera, et cetera. Is Taiwan the better play in the Greater China space, or is it about Hong Kong? Is it about mainland China itself? Where do I put cash?
Yeah, I think you can find things in all three economies that look very good right now. You mentioned technology, but what we're really on the precipice of is we're on the precipice of an all-out war in smartphone market share. Starting in the next couple of quarters, you're going to have a new iPhone, you're going to have a new Samsung Galaxy S, you're going to have new HTC phones. So what we're betting on technology is, one, that inventories have been run down too much globally, and then second, that there's going to be a really big build coming for smartphones and smart devices. Yeah, and
what gives you confidence in Chinese banks? You have China Construction Banking, you're holding ICBC, AIA, another financial firm that relies heavily on Chinese growth. But you've heard of Jim Chanos and people saying that we have a lot of bad debt on the books. What about those concerns? Are those already gone?
Yeah, well, I wouldn't say they're gone. I think he's right. There's a lot of bad debt on the books. But the question is whether there's more bad debt on the books than people think. And so far, I think that question is being answered in a negative. So what we're seeing is we're seeing China bank estimates creep upwards. And creeping upwards because asset quality is better than people have expected.
Yeah, one quick one for you is the yuan. Where are we going with the Chinese currency? I haven't seen it, I guess, weakness in the yuan since August 2010. Has this trend reversed? I thought it was just a one-way upward appreciation trend.
Yeah, well, I think if you look at the comments that came out last night from the Chinese authorities, I think they're comfortable with some appreciation, but they're always looking for excuses for it to depreciate a little bit.
Yeah, just help exporters out.
Help exporters, keep traders on their toes, make people realize it's a two-way trade, not just a one-way trade.
Make fund managers like you sweat a little bit. Work a little harder for it.
It's always good.
Howard, thanks for dropping by today.